Every 4 years, a handful of legendary teams walk into the World Cup as favorites. Massive stars, huge expectations, millions of fans certain they'll lift the trophy. And almost every single tournament, at least one of them crashes out early. Eliminated in the group stage, sent home before the real competition even begins. Meanwhile, a team nobody expected anything from, one that barely made it past qualifying, quietly keeps winning, match after match, round after round, until suddenly they're in the final, and everyone is asking the same question: how did nobody see this coming? Here's the uncomfortable truth. The same exact pattern happens in the stock market every single year. The obvious winners often disappoint. The boring, overlooked options often outperform everyone's expectations. And once you understand why that happens in football, you'll understand exactly why it happens with your money too. Most people invest the same way casual fans pick a World Cup winner. They look at the biggest name, the flashiest performer, the one everyone's talking about. They see a company in the news, maybe a hot tech stock, maybe whatever's trending that week. And they assume that because it's famous, it must be a safe bet. This is called recency bias, and it's one of the most common mistakes in investing. We assume that what looks impressive right now will keep looking impressive forever. We extrapolate the recent past directly into the future, without asking whether that performance is sustainable. Football fans do this constantly. A team has one incredible tournament, and suddenly everyone assumes they'll dominate forever. Then 4 years later, half the squad has aged, the manager has left, and the unstoppable team is sitting at home watching the final on TV. Investors fall into the exact same trap. A single stock has one spectacular year, and suddenly it feels like a guaranteed winner. People pile their savings in, expecting the streak to continue indefinitely. But here's what the data actually shows. In both football and finance, dominance rarely repeats itself in the way we expect, and chasing what already happened is one of the most reliable ways to lose money. Let's break down exactly why this happens, and what it teaches us about building wealth. First, concentration risk. In football, a team that depends entirely on one or two superstar players is incredibly fragile. If that player gets injured, has an off night, or faces a tough opposing defense, the entire team's chances collapse with them. We've seen it happen over and over. A team built around a single genius simply cannot function if that one person underperforms. This is exactly what happens when you put all your money into a single stock. If that one company has a bad quarter, faces new competition, or simply falls out of favor, your entire portfolio takes the hit. There's no depth, no backup plan, one injury, and the whole campaign is over. This is why diversification, spreading your investments across many companies through something like an index fund, works the same way a deep, balanced squad works in football. If one player has an off day, others step up. If one sector of the economy struggles, others can carry the weight. You're not betting everything on a single star. You're betting on the strength of the entire system. Second, let's talk about consistency versus flash. The teams that go deep into World Cup tournaments are rarely the ones with the most dazzling highlight reels in the group stage. They're the ones who show up, match after match, and quietly do the fundamentals right, defending well, staying disciplined, not panicking when they go down a goal. That's almost a perfect description of successful long-term investing. The flashiest stocks, the ones making headlines, the ones your friends are texting you about, are rarely the ones that build the most wealth over decades. The boring, consistent performers, the ones nobody's excited to talk about at a party, are usually the ones quietly compounding in the background. Third, and this is the part that matters most, let's talk about how fans react when their team goes down a goal. Panic sets in. People want to make immediate, drastic changes, substitute everyone, change formation completely, abandon the entire game plan in a moment of fear. But the best managers know the truth. Overreacting to a temporary setback is usually the worst thing you can do. The teams that recover from going down a goal are usually the ones who stay calm, trust their original strategy, and let the game play out. This is identical to what happens when the stock market drops. Your portfolio is down a goal. Fear kicks in. The instinct is to sell everything, panic, abandon the plan completely. But just like in football, the investors who recover and come out ahead are almost always the ones who stayed calm and trusted their original strategy instead of making a desperate emotional decision in the worst possible moment. Here's the deeper psychological truth hiding underneath all of this. We are drawn to excitement. In football, in investing, in almost every area of life. Our brains are wired to pay attention to what's loud, dramatic, and immediate, not what's quiet, steady, and long-term. That's why underdog stories captivate us, and why hot stock tips spread instantly through group chats. Excitement gets our attention, but excitement is not the same thing as a winning strategy. The teams and the investors who actually win over the long run aren't usually the ones generating the most excitement in any given week. They're the ones executing a sound, repeatable process, over and over, without needing to reinvent themselves every time something unexpected happens. There's another layer to this too, expansion and inclusion. This World Cup expanded from 32 to 48 teams. More countries than ever before get a real shot at the tournament. Nations that would have never qualified in previous formats are now on the same stage as football's traditional powerhouses. That mirrors something beautiful about how investing has changed over the last few decades. It used to be that only the wealthy, the well-connected, or those with access to a stockbroker could meaningfully participate in markets. Today, anyone with a smartphone and a few dollars can buy into the same index funds that institutional investors use. The playing field has genuinely expanded, but just like in football, having access to the tournament doesn't guarantee you understand the strategy that wins it. Access is no longer the barrier. Strategy is. So how do you actually apply all of this? First, stop chasing the team that's hot right now. Whether it's a football squad or a trending stock, recent dominance is not a guarantee of future performance. Build your strategy around fundamentals, not headlines. Second, build depth into your portfolio the same way a winning team builds depth into its squad. Don't put everything into one company hoping it's your superstar. Spread your investments through diversified funds so that no single setback can end your entire campaign. Third, expect setbacks and don't panic when they happen. The market will go down. Your portfolio will have bad weeks, bad months, sometimes bad years. The investors who win long-term are the ones who stay calm during the dip, exactly like a team trusting their game plan after going down a goal. Fourth, take advantage of the fact that access has expanded. You don't need to be wealthy or connected to start building real wealth today. The tools that used to be reserved for professionals are now available to almost anyone. Use that access. Don't waste it by chasing excitement instead of strategy. And fifth, recognize that the most thrilling stories rarely come from the safest path. The team that wins the World Cup usually does so through discipline that looks boring from the outside. The investor who builds the most wealth usually does so the same way. Consistency isn't exciting to watch, but it's what actually wins. Every 4 years, millions of people watch the World Cup hoping for a moment of magic. A single brilliant play that changes everything in an instant. But ask anyone who's actually lifted that trophy, and they'll tell you the truth. It was never about one moment. It was about hundreds of unglamorous decisions, made consistently, over years of preparation, that nobody was watching. That's exactly how wealth gets built too. Not through one brilliant stock pick, not through one lucky break, but through the same quiet, repeatable discipline, showing up, staying consistent, not panicking when things go down a goal, applied patiently over years. The World Cup will end on July 19th, and one team will lift the trophy, but the lesson it's teaching us about money, that one never ends. It just keeps compounding, season after season, for whoever's willing to stay in the game. And that is a wrap on today's video. If this gave you a new way to think about both football and your money, hit the like button. It genuinely helps more people find this channel. And if you're not subscribed yet, tap subscribe and hit the bell so you never miss a video. Every single week, we break down another money topic, just like this one. I'm Mark from Mark the Investor. I'll see you in the next one. Take care.